Guys, good morning. Good to see both of you.
Good to see you too. Good morning, guys. Good to be back.
Ibrahim, I mean, we talked earlier this morning about some of the, I guess I'll call them nitpickers, of just focusing on the regulatory credit sales. But I have to imagine at this point that maybe you are impressed with the level, at least of demand momentum and supply momentum that Musk has built.
I mean, they eked a profit from their automotive division, so that was fantastic, and that was very encouraging. Their actual regulatory credits were down from last quarter. Yes, double from last year, but down from last quarter, and they eked out a profit. I was thinking this morning of you when you asked me last time I was on why the S&P Index Committee wouldn't put them on, and it was because of the GAAP accounting piece. And I think now they're going to be reconsidering. Yes, if you remove Elon's compensation, which was something like $580 million worth of stock options, the company would have produced close to $1 billion worth of profit right there. So I think they'll be coming around.
Yeah. How about you, Colin? I know you got an outperform, and I think you went almost to 490, right?
Yeah, we went to 480 with our price target. There's two things that we're looking at. First was the automotive gross margins. They were up from 18.7 to 23.7, and that's actually the credits. And that really speaks to the efficiency of the manufacturing as well as the price stability that they have for the products. So as we look at that, that number as we scale up and some incremental efficiency in those factories, thinking about auto company that has 30% plus gross margins is definitely not out of the realm here. And the earnings leverage on the platform is tremendous. We saw that with the free cash flow this quarter with $1.4 billion of operating cash flow after the big capex number at $1 billion. It's there's a lot of leverage in this, and they're really investing in process technology to advance their lead here.
Colin, we seem to be doing this really weird dance when it comes to Tesla, where most of the time people are saying, well, it's not an auto company and shouldn't be valued that way. But right after earnings, we're looking at the numbers that show it's an auto company and how profitable are they and how many vehicles are they able to produce. I'm not sure for the investor right now that should really matter. What do you think are a couple of the most important metrics about this company writ large that really matter that might justify this valuation?
So for us, it's really about the process technology that they're developing. So moving into the battery manufacturing and some of the IP that they gained with the Maxwell acquisition about 1.5 years ago. Additionally, this molding technology that they're using to simplify manufacturing and clean up the process, that's important for us in terms of keeping a lead on a cost structure. So one of the things we wrote about this morning was the leverage that they're getting on just the manufacturing on the durable goods and being able to leverage their cash position into more recurring revenue streams, whether it's software related to their full self-driving or the insurance products that they can bring forward and spread out across the globe, just because they have a data advantage. And so that's what I think people are looking at is, fully disrupting not only just the manufacturing piece of this, but the rest of the associated businesses around auto ownership and transportation.
Shepard Smith here. Thanks for watching CNBC on YouTube.